Hello, everybody. Thanks for checking in. I am your stock market jobber, aka as Mark, which is my birth name. But I prefer to go by stock market jobber at this point. So, anyway, I am a former institutional trader. I spent years trading in various hedge funds and head of trading at different money managers. You probably know some of the, or have heard of some of the people I've traded directly for. Steve Cohen, Mary Gabelli, two of the greatest in the history of the industry. I was also a market maker, and in my role as head of trading at different money managers, I oversaw pretty much every strategy you can think of. And everyone's really interested in hedge funds for some strange reason. If you go to our market lessons page, you can check on the lesson about hedge funds, and I will teach you what hedge funds really are, or what they really do. But at this point in my career, I've decided I want to kind of give back and help people learn how to trade because it really kind of frankly bothers me that there's so much misinformation out there. So we're going to talk about SPY, but to be perfectly frank, there's really not too much to talk about. It's pretty much right where we were yesterday. We're below yesterday's high. We're still hanging around this really important 410 level. We closed at 414, which we're talking about a 410 or $414 security. 4 points is really nothing. I mean, we're still right there. But a lot of you have been asking me about my opinion on SPY and could the Qs, and could I start talking about the Qs? And the answer is of course. So if you want to hear my opinion or have me help you with something, feel free to reach out to me on YouTube, but you got to subscribe to the YouTube page. And you can't just throw symbols at me. You got to give me like post a chart because I don't know what your time frame is. I don't know your style. People just fire off this like, hey, what do you think of XYZ? What do you think of ABC? It's like, dude, I don't know. But anyway, I've gotten some very intelligent questions on the Qs, so we're going to look at the Qs tonight. The Qs are the NASDAQ 100 ETF. These are the 100 biggest companies in the NASDAQ that don't or that aren't in the financial sector. So we can see a couple things going on here. And this is just a little trading lesson. It's not a recommendation. But one of the things we talk about at Stock Market Jobber is the importance of price levels. Now we can see down here, this $260 price level was important. It was support here, support here, and support here. How can you benefit from this? Well, just say Qs was in a downtrend and you thought, I'd really like to buy these. Where should I buy it? I'm not going to buy it if it gets to 250. Well, you know what? Maybe you were right because the thing went up, but you would have missed out because you didn't realize there was a support level there. You can't just come up with arbitrary numbers. You have to let the market tell you what to do. And if you're looking at the chart and you're reading it correctly, and this is what I teach people how to do, is to understand that the market is always right and people are not always right. So you see this downtrend and you're like, you know what, I want to buy Qs. Instead of saying I'm going to buy it at 250, you look at the chart and you see like, oh wow, there was support at 260. A lot of times support levels can become support again. So maybe you place your buy order around 260 or 261. It's not as good as buying it at 250, but it's better than missing it. So levels that are important can retain their importance for a while. And here we see a support level that was important from October up until January. Now here's another thing. Levels that were resistance can become support. And we could see that here around the 280 level. How does this happen? Why does the stock like this level, or the ETF in this case? I don't know. I don't know why it likes the 280 level, but I don't need to know. I just need to know that it happens. I don't know how electricity works. I know if I flick on the lights, flick the switch, the lights come on. But anyway, resistance can become support because there are people who sold here who thought they did a good thing when the market went lower, but when it gets higher, a lot of these remorseful sellers tell themselves, you know what? I made a mistake. I want to buy my shares back, but I'm only going to do so if I can get them for the same price that I bought them at. Sold them at. So we have remorseful sellers placing their buy orders at their sell price. If there's enough, the level that was support, I got it backwards. The level that was resistance becomes support. All right. So what we're looking at here is psychology. Charts should be viewed through the prism of supply and demand and psychology. So up here we have a resistance level. Okay, this is, I don't know what level this is, probably around 295. And we can see that for here, like for 4 or 5 days, it was resistance. So as we've just seen, levels that were resistance tend to become support. So if we do get some selling and we get back down here, it might be time to buy. We could get a bounce there. Now, another thing I want to point out here is levels that are support can become resistance. This happens because of buyer's remorse. Think about this. There were people back here who bought these shares after this thing ripped lower. And they were like, oh man, this is great when it moved higher. But the price drops, and a lot of these people or investors become remorseful. They say, you know what, I shouldn't have done this. I made a mistake. I want to get out, but I'm only going to do it if I can get out at break even. So I'm going to sell my shares if they come back to the price I bought at. So you have remorseful buyers placing sell orders at their buying price. So support can become resistance because of buyer's remorse. Resistance becomes support because of seller's remorse. Support becomes resistance because of buyer's remorse. Now, another thing we have on the chart here is this red line. This is what's called a Bollinger Band. It is 2 standard deviations above the 20-day moving average. Why is this important? Well, according to statistics and probability theory, at least that's what they tell me, because I'm certainly not a statistician, but I can look at the chart. Um, Hold on 1 second, honey. I'm on the phone. Sorry about that. My daughter just was calling me. If we get above this line, it tells us that we're overbought. This means that the trading has been so aggressive, we've driven ourselves to levels that are higher than what would be the usual or typical trading range. And that's important because traders will be expecting a reversion to the mean, and they will come into the market as sellers, and their selling could push the price down. As we can see, that happened here, and that happened up here. So if we move higher, I'd be looking for resistance there. If we move lower, I'd be looking for resistance there. So that's it, everybody. Thank you for tuning in. Please make sure you subscribe to Stock Market Jobber, our YouTube page here. And I want to teach people how the stock market really works or how trading really works. And we don't, in the institutional trading world, we don't focus on really bizarro things like Elliott wave or Gann theory. We look at what I'm talking about here: levels, trends, momentum. Understanding them is the secret to success. All right, everybody, thank you, and please come back soon, and I will see you then.